Hi there, welcome to kneppyinvests. In today's financial year 22 results video, I'm going to be looking at a recently listed company on the ASX, IPD Group. And the question I am asking, is this the best performing ASX IPO over the past year? In fact, the share price of this company has, more than doubled. I think the share price, they IPO'd around about $1. And the share price now is above $2. So this company is actually doing better than the overall market. And one of the reasons why this company has been doing better than the overall market is because the company has issued two earnings upgrades. And if you have watched all my videos, you know what I think about earnings upgrade. In my opinion, profit upgrades are the most powerful type of announcement a company can give to the market, because what it tells us is the company is performing better than the management expectations. And that's why the share price of this company has doubled. And that's why the share price of this company is in a well-defined uptrend. Now, one of the things I do with IPOs is I wait at least 6 months. I prefer to wait at least 6 months. But when IPD Group did release their first profit upgrade, I decided to take a position, a fairly small position in this company, even though it did break one of my rules, simply because of that upgrade. And one of the reasons I do like to wait at least 6 months before I buy into an IPO is simply I want to see the first set of financial results from a company. And we've now seen two financial results from IPD Group, and this company is performing really well at this point in time. Now, because this company is a newly listed company on the ASX, I still would want to wait a little bit of time. And I do know some investing groups out there wait at least 3 years before they even think about investing in IPOs. I think that's maybe a little bit too long, because with most IPOs, we do have at least 2 years of history when they IPO. So companies release their previous 2 years of financial results. But I think what these investing groups want to see is when a company does list on the ASX, there's one reason they list on the ASX, and that is the ability to get more capital into the business. So, for instance, capital raisings, or even during the IPO process, there's a flush of cash coming into the business. And usually, companies want that capital, that cash, for growth reasons. For a lot of non-profitable companies, that cash is simply there to make sure the company survives for the time when they're not profitable. But IPD Group was profitable, and at this point in time, it looks like they are using the cash that they received during the IPO process to make acquisitions. So this is I wouldn't say it's a highly acquisitive company, but they have acquired 4 companies over the past 2 years. And at this point in time, it does look like the acquisitions are working, but it's not the sort of strategy that a company wants to maintain over the long term. Eventually, this company will have to grow, and the majority of their growth will have to be through organic ways. Before we have a look at IPD Group, I'm going to continue doing these financial year 22 results videos for at least the next 2 or 3 months, trying to get through as many companies as I can. And one of the benefits of me doing these videos is I'm learning more about companies I probably would not have done any research on in the past. And the next 5 companies I'll be looking at include 4 companies, to be honest with you, I have not looked at all in the past 5 years or even longer. And that includes NextDC, Imdex, GUD Holdings, High Tech Group. So those 4 companies I haven't had a close look at all, and I'm really looking forward to going into a little bit more depth into those businesses. And the one company I have done a fair bit of research on, PWR, Advanced Cooling Technologies, I really like that company. Not a shareholder at this point in time, and I probably would argue at this stage, right now, on the 7th of October, PWR is maybe a little bit overvalued. So you do have to pay a little bit of a premium right now to be a holder in that company. Before we move any further, I thought it'd be a good idea just to describe exactly what, maybe not exactly, but to give a short introduction to this company. What does IPD Group actually do? And the company itself can be split into 2 divisions, a product division and a services division. So that service or the products division is the sale of electrical infrastructure products to customers that include switchboard manufacturers, electrical wholesalers, electrical contractors, power utilities, OEMs, and system integrators. And there's 5 main categories of products: power distribution, industrial and motor control, automation, industrial communication, power monitoring, and electric vehicle solutions. And that's one thing I'm actually quite interested in this company. And that electric vehicle solutions is mainly through a recent acquisition they did make, which is Gem Tech. The other 3 brands in their product division include IPD, Control Logic, and HTC, which is High Technology Control. Their selling division, they provide a range of services including custom assembly, sourcing, engineering design, technical compliance, procurement, transport, storage, regulatory management, technical support, packaging, labeling, inventory management, and delivering. And they have 4 main categories of service: installation and commissioning, calibration and testing, maintenance and repairs, and refurbishment and other. One thing I like to know in regards to the different divisions is the margins. I probably would assume, and this is just me assuming, and of course we all know when you make assumptions, you are liable to make an ass out of you and me, but I am assuming that the services division has lower margins than the product division, just because I just think of services as having less or lower margins. So that's my assumptions here. But if product division has lower margins and they're increasing their services, that would be good for the future of this company in terms of their profitability. So this is mainly an Australian-based company. And if you do look at the locations of their products and services, you'll notice they have locations in Sydney, Brisbane, Melbourne, Adelaide, and Perth. And for the services, they have Sydney, Melbourne, Bendigo, and Burnie, Tasmania. Now, there's one thing I did notice is they do have a Sri Lanka-based business, which is IPD Sri Lanka. It's not mentioned in the locations part of this particular slide, but they do mention Sri Lanka a couple of times in the presentation. So I'm not exactly sure why they decided to exclude Sri Lanka from in this particular slide. Now, onto one of the most important decisions you have to make, or I have to make as a person who researches a company, is deciding upon whether a company is high quality or low quality. And the reason why it's important for me in my investing process is the way I treat high quality companies is totally different than the way I treat low quality companies. For high quality companies, it's all about the value. Is there good value in the company right now? I don't really care about the share price trend and the sentiment in the company at that point in time. But if it's a low quality company, the share price trend and the sentiment is much more important than the value. So what do I think about IPD Group? Is this a high or low quality company? Now, for the very fact that this company hasn't been listed on the ASX for very long, I don't have a lot of financial history in regards to the company. I probably would skew towards the low quality spectrum. And one of the reasons behind that is I don't want to take as much risk in this company. But I do have a small position in this company right now. And one of the reasons I do have a small position in this company is because of those upgrades and because of the share price trend. And we'll look at the chart towards the end of this video. And it's one of the best looking charts on the ASX right now, in my opinion. Now onto the financial year 22 results for IPD Group. And before we have a look at the revenue, profit, and operating cash flow, which is quite important, what is the valuation right now on October the 7th, 2022? So a share price of $2.07, which was a share price at the end of trading on this Friday, the 7th of October. The market cap of IPD Group is 178 million. So right now we have sort of a base where we can judge the valuation of this company. But again, because I don't really consider IPD Group to be a high quality company just yet, valuation is not quite as important as the share price trend, but we look at the chart later in the video. So in financial year 22, IPD Group had revenue of 177 million, and that is growing. And we'll have a look at the revenue growth later in the video, probably the next slide. Company had profit of 11.1 million. So this company is profit, and just like revenue, profit is growing, and operating cash flow of 8.8 million. Now, that operating cash flow is what I calculated, not what the company reported, because I take away leases from the operating cash flow. It's just what I do. So that 8.8 million, if you add back the leases, is 11.5 million. And the earnings per share for this company is 14.3 cents. Now onto the revenue growth for this company. And usually I look at least 10 years of history, but IPD Group has only been listed for a year. And I could have gone to their prospectus and looked at the revenue for the previous 2 years. But fortunately, IPD Group has provided 4 years of history in their presentation. So that includes financial year 2019, 2020, 2021. They've also given Proforma numbers and statutory numbers. So Proforma numbers, Proforma means if they had made these acquisitions, this is what the revenue would have been in 2019. So they have made 4 acquisitions in the past 3 years. Adelac in financial year 20, Control Logic in financial year 21, HTC in financial year 22, and Gemtech in April 2022. So Proforma revenue is, particularly in financial year 2019, 2020, that's what the revenue would have been if they had those acquisitions for those years. And statutory revenue is the revenue they would have reported if they were reporting to the ASX. And you'll notice that Proforma revenue has grown over the past 4 years at 10.2% per year. But the majority of that growth has been in the past year, where revenue has grown from 142.6 to 180.5. Revenue was fairly flat in financial year 2019, 2020, and 2020. But if you look at the statutory revenue, it has been growing at 32.6% per year, increasing from 75.8 million in 2019 to 176.8 million in financial year 22. So it just shows you how powerful, how strong the growth in revenue has been due to acquisitions. There's been a little bit of organic growth, but the majority of growth in the revenue for this company has been because of acquisitions. So it's very important eventually that this company can grow and show the market they can grow organically. Now onto the only financial statement I show in this particular video, the statement of cash flows. I usually will show you the reconciliation of profit to operating cash flow, which is note 28 for IPD Group. I'm not going to show you that. Instead, I'm going to show you one of the slides they did provide to get a better sense of why operating cash flow didn't grow quite as strong as the previous year. So when I do look at a statement of cash flows, there's a few things I will look at here or focus on. First thing is receipts to customers. And we've already got a sense of revenue and revenue growth from the previous year, and receipts from customers did grow from 125 million to 186 million. Now, for me, receipts to customers is more important when I look at Appendix 4Cs, which is core reports for non-profitable companies, or those companies have been profitable for very long. And right now we're in October, and October is Appendix 4C and 5B season. So I am waiting for a lot of companies to produce their quarterly reports. And that's when I really focus on receipts from customers and receipts from customers growth. Now for IPD Group, we are seeing receipts growing just like revenue is growing. So the next thing I look at is operating cash flow. And I want to see if it's positive or negative. Then I want to look at the growth from the previous year. And maybe a red flag here is that IPD Group's operating cash flow didn't grow all that much from last year. It increased from 10.3 million to 11.2 million. So I want to know why, or try to understand why there was anemic growth in the operating cash flow. And you can find that in note 28, or the reasons why in note 28, or the slide I'll show you in a second. The last thing I usually look at here is the cash on hand at the end of the year. And this company went through the IPO process and they received $20 million through the proceeds from issues of shares. And even though they spent $9.3 million on dividends, $2.5 million on share issue transaction costs, $2.4 million on repayment of lease liabilities, and $2.3 million on the acquisition of subsidiaries, they still increased their cash on hand by $13 million because of the issuance of shares through the IPO process, and finished this particular year with $25.4 million. Now, one of the reasons I really like a lot of cash on hand, and to be honest with you, even though $25.4 million might not seem like a lot of cash on hand, for a company with a market cap of $178 million, that's a fair bit of cash. The other thing is, a true sense of the valuation of this company is if you take away the cash on hand, and that's net cash because this company doesn't have any debt, from the market cap that's a truest sense, which is the enterprise value. That's a truest sense of the valuation of this company. So the enterprise value of IPD Group is around about 150 million. So I consider that the true valuation, not the markup of this company. Now, one of the reasons I really like company having a lot of cash on hand is because it gives a lot of flexibility to the decisions made by management. And one of the most important decisions companies have to make, or management of companies have to make, is capital allocation decisions, which is decisions around the cash inflow from operations of a company. What are we going to do with the cash that is coming into the business? Or what are we going to do with the $25.4 million of cash we have right now? And the four decisions they could decide upon, or choices they could decide upon, include dividends. An IPD Group will be issuing dividends to the shareholders. They could do a share buyback if management think the company is currently undervalued. That's a definite thing they could do. Maybe some research and development, but I don't think this company would do that. The other thing, of course, is acquisitions. And we've already seen in the past, the last 3 or 4 years, this company has been highly, well, maybe not highly acquisitive, but they've made 4 acquisitions. So I definitely think the company will keep on issuing or giving back some of the money in dividends back to the shareholders. And they'll also use some of the money they generate in their operations by making some more acquisitions in the future. Instead of showing you note 28, which was a reconciliation of profit to operating cash flow, this is just one of the slides they did have in their presentation, which is pro forma cash flow. The reason I'm showing you this is we can compare pro forma financial year 21 cash flow to financial year 22. And they also had some numbers in their prospectus, and they simply destroyed their forecast numbers in the prospectus. And that's one of the reasons why the share price has doubled over the past year. So EBITDA has increased from $16 million to $22.1 million in financial year 22. But they've also got a change in working capital here. So the change in working capital was $11.4 million in financial year 22, significantly higher than last year. Now, changes in working capital, increases in inventories, increases in trade receivables, and decreases in trade payables. And they've mentioned in the commentary, working capital increased to support revenue growth. So if you do have a look at the balance sheet, you'll notice that inventories have increased, trade receivables have increased, and I think even trade payables have increased as well. But overall, changes in working capital, 11.4 million, and that's the reason why operating cash flow wasn't quite as high as what you might expect. And it's not a bad thing to have this bigger or higher change in working capital, unless there is one possible negative, is if they go too hard in increasing the inventories and then they have to sell that inventory at a discount. So that is one thing you always have to look at, particularly this year. A lot of companies out there have significantly built up the inventories, and I think some of those companies, particularly retail companies, might have to sell a fair bit of their inventory at discounts. The other thing you have here in this pro forma cash flow is capital expenditure and acquisitions, $2 million spent in financial year 22, and then you get the free cash flow. So $8.7 million of free cash flow in financial year 22 compared to $10.7 million in financial year 21. But if you compare it to their forecast in their prospectus, they only expected to bring in $6.2 million of free cash flow. So that's a 40.3% higher free cash flow than they expected. Not only that, operating cash flow was 44.6% higher than expected by the prospectus, and EBITDA was 22.1% higher than they expected, which was in their prospectus. So again, we get a sense on why the share price of this company has doubled, why the market is a little bit excited about this company right now, because they beat their prospectus guidance, and there is that sense that maybe this company can continue that in the next few years. Now onto the valuation of IPD Group, and all these valuations are looking at the market cap, not the enterprise value. So you could probably actually, so the PE ratio is looking at the markup divided by the profit, or maybe the share price divided by the earnings per share. You could actually look at the enterprise value and then compare that to the earnings. And if you do that, the PE ratio would be lower than 16. Price to sales ratio, 1, and the price to operating cash flow, 20.2. I really like looking at enterprise value to operating cash flow. And if you actually do that, again, you get a much lower number than 20. Just based off these particular valuation metrics, the valuation of this company is not too stretched at this point in time. Also did a reverse DCF based off the free cash flow, or was it the earnings per share, or one of the two? Anyway, and for this company to justify the current valuation, it only has to grow at 10.4% per year over the next 10 years, which I don't think would be too hard for this type of company, particularly if they keep making really good strategic acquisitions. But again, I've already mentioned that eventually the company will have to show to me they can grow organically and not just through acquisitions. They are growing slowly through organic ways right now, but I'd like to see that increasing. And finally, the chart for IPD Group. And this is almost a one-year chart because the company did list on the ASX in December 2021. But this, as I've mentioned, is one of the best charts you'll see on the ASX. And I'm just assuming that because the majority of companies have seen the share price drop in the past year, unless you're coal companies. So you probably get an argument, and I probably concede to you if you suggested to me that Whitehaven Coal, New Hope Coal have much better charts than IPD Group, and I'll probably have to agree with you. But apart from coal companies, this is one of the best charts on the ASX, a well-defined uptrend, a beautiful uptrend developing in IPD Group. You see little pullbacks in the share price, and whenever you see a pullback in the share price, that's a good time to buy. So right now, share price in a well-defined uptrend. The one negative thing, and if I only had a negative thing or one negative thing, I'd probably say I'd like to see a little bit more volume coming in over the past few months. The biggest volume we have seen, and this is not a surprise, was the day they IPO'd, and then the next few months later, then the interest has died away. So I'd like to see increasing volume. And if we start to see increasing volume, that would be telling me that there would be fund managers out there getting a little bit excited about this company. And it's going to be the fund managers eventually who drive the share price of this company higher, particularly if IPD Group keep on impressing when they give out their financial results. So it might take a few years for quite a few fund managers to notice IPD Group simply because they are a small cap company. Markup is still fairly low, and they've only recently IPO'd onto the ASX. So it might take a fair bit of time for the share price to get to its true value if they keep on impressing in terms of their financial results. But that's the reason, and that's one of the advantages we have over fund managers. We can take positions in these sort of companies, these small cap companies that are growing and have only been listed on the ASX for a short period of time. That's all I have for this video looking at IPD Group and their financial year 22 results. Is this the best performing IPO on the ASX in the past year? Now, to answer that question wouldn't be that hard. There's actually one website I know I could actually find out this answer. So I won't do it now. I'll do it after I finish recording this video. So if you do have any questions, any thoughts, any concerns, leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.